Have we started recording? Yeah, we have started recording. Good evening, ladies and gentlemen. My name is Impeko Tabang, and this is my YouTube channel where we're gonna be teaching our first year student. So I decided to start this YouTube channel during now second semester. So we don't have like any lecture for first semester, but for students who are doing quantity survey, where you have modules like economics, but today I'm going to be doing macroeconomics. We have macroeconomics, we have commercial law, building discipline, we have building science, environmental and science, something like that. We have a material method for building science, another building science, and we have our quantities, which are these we're gonna have to touch it very nice, right? And then beside that we also have um what else? We have QS, which is quantity survey. We have QBD, which we did in the first semester, but I didn't upload the video for that. So those are the things that you're gonna face if you are doing the field of being a quantity surveyor in varsity. And we have also double RFV, which I'm not gonna touch in double RFV because yeah. So today we're going to be doing about money and the price level and inflation. So which is a very nice topic to learn about, guys. So money is like you're going to be learning about money, how money is actually being created, how all of these things, So first of all, we're gonna these are the main ideas of what we're gonna be learning about. You're gonna have to define money and you have to describe its function. So whereby money is the token that we use as a means of payment, right? So like when you try to buy something and then that person is selling like a goods or something, so that's a token that you're gonna use so that you can get that goods that you want. So it's a token that we use as a means of a payment. So we have three functions of money, guys. So we have a medium of exchange. Money is a medium of exchange. What we mean by medium of exchange is that without money we're going to use like a method of trade where we're going to trade goods for another goods, right? So now there's that we have money involved, which means that it's not going to be difficult for us like to trade. So which means that we're not just gonna say, okay, I need this kind of goods, here's the money. So every seller, of course, I will always accept money, right? But if there was no money, if money was not a medium of exchange, which means that we're going to be exchanging goods for another goods, it was going to become difficult because you're going to have to find someone with that particular goods that you want, and which that good that person wants from you. So if you don't have like a good that the other person wants, so you're not gonna have to exchange that kind of goods, you see. So that's the medium of exchange. Medium of exchange is actually talking about money. It's a medium of exchange. It means that we can actually um give someone money in exchange of a good. That's a medium of exchange. Then we have another function of money, which is unit of an account. So unit of account is like money is like a unit of account, which talk about currency actually. So unit of an account is like when you're talking about unit of an account, it's like money actually it does it have like this thing, okay? It have like it actually create a budget of how much money you're gonna actually use, you see. So that's why we have like currency. We have 10 rand, you have 20 rand, you have something. So if you're trying to buy a cup for like 10 rand, so you know, okay, this I'm gonna budget this cup for 10 rand. So it acts as a unit of an account. And then money also acts as a store of value. Why? Because like money you can keep it. Okay, we have like things that can be stored that can last for you, like a car. If you buy a car and then it loses value when it comes out, you have a house which actually increases value when you're is being used regularly, like in a year it increases value. Even money actually you can store it for a value so that you can store it and then use it in the future, but that one depends on the inflation. So what we're actually talking about inflation is like the increase of price rapidly, right? So it depends on the inflation. So if the inflation is actually high, so which means that your money that you've kept for a very long time will be useless. But then if inflation is low, then that money will be useful, so you can buy many things with that money that you've saved for a long time. Then we're gonna have to explain about the banking system and how this money is being created. We're gonna have to explain and determine the demand for money, the supply of money, and the normal the normal interest rate, nominal interest rate. We're gonna have to explain how the quantity of money influence the price level and the inflation rate in the long run. And then we're gonna learn about that the short run in chapter 32, right? So we're gonna have to learn about the monetary policy. So you're gonna have to learn about the calculation. That calculation, we call it the money multiplier actually. So that's the calculation of calculating money and everything. So what is money? Money, as I've already said, money is a means of payment. So it's a method of setting a debt, you see. So money serves like three functions. It serves a function of a medium of exchange that I've already explained. So a medium of exchange is an object that is generally accepted in exchange of goods and services. So you exchange money and that person gives you goods. Unit of an account is an agreement measures for stating the price of a goods and services. That the price, I give an example of a cup. You have a 10 rand, you want to buy a cup, you exchange with the price which is 10 rand. So it's a unit of an account. We have a store of value. Money is store of value in the sense that it can be held and exchanged later for goods and services. You can buy a good or services later, but it depends on inflation, right? So you have to know if the inflation is high, then the money that you have stored will be useless. But then if the inflation is low, then the money will be useful. So we also have this actually talks about currency, like the notes and coins held by individuals and business. So you have to know about currency. We have what we actually do call this we're actually talking about money here in South Africa, right? So money in South Africa, you have to look at currency, you have to look at deposit. So currency is like notes and coins held by individuals and business, right? So if notes and coins are held by individuals and business, we call that thing money. So currency is actually money. And then we're gonna have a deposit, which is also money, because a deposit, it actually talks about money that is being deposited in institution like banks and everything, depository institution. So you deposit money, so we call that also money because it's being deposited by individuals and firm to the banks. And we have official measures of money, which are three, but here they did mention three. We have three measures of, which is M1, M2, and M3. So there are three main measures of money in South Africa. So we have M1, which consists of a currency plus check deposit owned by individual, right? So and businesses. So M1 actually consists of money. Why? Because it is a currency, it's a notes, right? So as we have already mentioned in currency, was we did say already M1, it is a currency actually. So if we look at the notes that are wrote here, deposited by individuals and firms, and it is money. Anything that has to include individuals and firm, it is money. But then if it was deposited by the government or by the bank, it wasn't gonna be money. So when we're talking about M2, it has like that 50% of M1. So if we're talking about M1, we know we have a currency, right? We have the currency, the notes and coins that have been deposited by individuals and businesses. So M2 has that 50% of M1. So which means that that 50% also make it money, right? Yeah, then we're gonna have M3. M3 is actually like M2 plus money that is deposited for a large time horizon. So it has like that function of M2 because it's M2 plus the money that has been deposited. So if we're talking about money that has been deposited, we already talked already, currency is money, deposit is money. So M1, M2, and M3, they are also money, right? So when we're talking about deposit are money, but debt are not. Debit card are not, and checks are not. How so? Deposit, I already mentioned that deposit is money, right? But um debit card and checks, they are not money. How so? Deposit are money because they are being deposited to the banks by individuals and business, right? But then a debit card is like that card that you actually use when you go to buy clothes at Mr. Price or anywhere else. So that card that you're gonna use, you're gonna insert that card, and then that card is gonna create a debt because the money, it won't be taken like rapidly at that time, but it's gonna have to wait for some time. So which means that you create a debt, and then creating a debt is not actually money. So when you didn't exchange it as a means of money at that point, you just like created a card and then tap the card and then created a debt, which means that the money is gonna be deducted from your account. So which means that you didn't actually use money. So a debit card is not money. And then we have checks. actual checks that are written by individuals, they are not money. If like you come to me and then I write you a check like, okay, let me give you 1 million right now, and then I just write a check and then I give you the check, that check is actually not money because I just wrote the check and I haven't transferred the money yet into your account, right? So the check is not money. Debit card is not money. And then we also have a credit card, which is not money. Why? Because a credit card, when you go to buy something, they're gonna ask you for an ID. So why do we have to include an ID when we're talking about money? So credit card is not money. Debit card is not money, and checks, which checks written by individuals, not just only checks, right? Checks deposit our money, right? We have check deposit our money. So we have how many things that are money? We have currency is a money. We have deposit, which is a money. We have M1, M2, and M3, which are also money. And we have currency deposit, which is also money. Debit card is not money. Check written by individuals is not money. And the credit card is also not money. So you have to understand this thing of being money. So when we're going to unit number 2, we're gonna be talking about depository institutions. What are depository institutions? So depository institutions are those institutions that actually accept deposit from individuals and firms. It's so easy. Like we're gonna be talking about banks, right? Capitec Bank, we're talking about Net Bank, Standard Bank. So those are depository institutions. They actually accept your deposit. You can go to Capitec and then say, okay, now I want go and deposit this kind of money, this kind of amount of money, and then just go and deposit. So we call those institutions depository institution, right? So you have to know the depository institution. So these are institutions that actually takes deposit from individuals and firm, and they loan those deposits to the other individuals. So that's what actually Capitec do. So when you go to Capitec and then you deposit money, they're gonna accept that deposit, and then they take that deposit of yours. They actually lend it to other people, to other individuals, and then when those other individuals pay back that money, the interest is gonna be high, right? So which it gonna make that money to cover the deposit that you've actually deposited into the account. So the deposit that you actually deposited into the account is still gonna come out. It's not like it's gonna be gone to somewhere else, because those banks, they provide a high interest rate to people who actually lend money. So if you lend money from bank, that money is actually gonna come back like higher than the money that you actually lend. So it can cover like the deposit money that you actually deposited, and then that can still cover the amount that you actually deposited, and it's gonna be like nothing happened. Where else, like the banks are actually making money out of that, because if you are paying someone with a high interest rate, there's actually a profit, right? So banks, they actually, that's how actually banks create money, which we are gonna talk about on the next chapter, the next unit. So we have four types of depository institution. We have 4 types of depository institution. Bear that in mind. We have a commercial bank, right? We have a mutual bank. We have a post bank. We have a land and agricultural bank. So commercial banks are like those banks that are, they have shareholders. This one, banks like Capitec, Standard Bank, and everything. But then mutual bank, they are different from commercial bank, because mutual bank, they don't actually have shareholder. The shareholder is actually the person who deposit the money in that bank. Those are the shareholder. Individuals and firms that actually deposit the money, they're actually shareholders. So that's a mutual bank. When we're talking about the post bank, those are the banks that actually create the credit card, the debit card, all this card that you use, the card that you have right now, are created by a post bank, right? So when we're talking about a land and agricultural, you can say, you can even hear the word land and agricultural. Those banks, they actually provide debt to people who have agricultural things, like, people who actually have land, or people who have we can be talking about chiefs. Uh we call that yeah, we know, if you're a South African, you know that we call those people abantu basebukhosini and everything. So people who own a land, people who have uh your farms, yeah, actually farms, people who have farms, they have the agricultural, they have they plant something, they have so those people, they actually get debt from the agricultural bank. So which is a very nice thing to know. And then we're gonna have a profit um and the president. So you have to know, right, the profit and and President and Prudence, a Balance Act, right? So the aim of the bank is to maximize the net worth of the shareholders. So therefore, interest rate at which bank lend exceed the interest rate it pays out to the depositors. That is what I was talking about the interest rate that the bank actually takes when you lend money. So that's how they actually make their net worth. You see, so that's the aim of the bank actually, to maximize its net worth. How does it do so? The interest rate at which the bank lend exceed the interest at which it deposits. So if you go to the bank and try to lend money, the interest is going to be higher than the person who actually deposited money. That is what they actually do. So the interest rate is going to be higher if you lend, but then if you deposit, it's going to be lower than the one that person who actually lended the money. um so that's how they actually create money. That's how they create their net worth, to maximize their net worth. And then the bank must prudent in the way it uses its deposit, balancing security for the depositors against profit for its shareholder. um we're gonna have to talk about depository institution, what they actually do. So a depository institution, we still know, you have to bear in mind that we're actually talking about banks, right? So what is it that they do? You can think about it and sit down and be like, okay, what actually banks do? What is it that they do? So bank, what they do, they actually provide things such as check clearance. See, so you can go to bank and then you go with a check and then you want to cancel the check, so they're gonna cancel the check clearance. They're gonna the account management, credit card, and internet limitary. Yeah, I think I did write this thing right. Internet banking. So internet banking, credit card, account management, and check clearing. So account management is like they're managing your account, right? So they're the person who actually know, right? Okay, this amount of money has been out of this kind of account. This amount of money has entered into your account. They manage your account. They do credit cards. They do internet banking. The internet banking is like the way you use your phone, like to transfer money and everything. But that is how they actually get their income, because they press charges on all of those things. So that is how they make income. When you're using the internet banking, sometimes when your money is being deposited into your account, or you're actually sending someone an account, it's gonna like decrease like a 2 rand or something. So that is the income that they're actually making. So imagine, like, the whole South Africa, we have like almost like 2 million people are actually using a bank, and they may be transferring. So the charges that they actually are being charged, they are the income that are actually going to the banks, right? Yeah, so that is actually how they make their income. um okay, I talked about commercial law funds. It receives from a depository and funds that okay, yes, this is the thing that we have to talk about now. We have to talk about commercial bank, enlists the fund it received from depositors and other funds that it bonds into 4 types of assets. Then we have 4 types of assets, right? We have a bank reserve. The bank reserve, we're actually talking about SARS. And don't mess with SARS if you want to know what happened to Dr. Malinga. So we have SARS, we have a liquid assets, we have investment security, and then we have loans, which are the most highest. They are the riskiest. So banks, they actually take risks on doing loan. If they're lending you money, they're actually taking the most risk. So that's why taking loan, they actually they provide a highest interest of them all, like the one that exceeds like all the type of assets. We have 4 types of assets: the bank reserve, the liquid assets, the investment security, and the loans, right? So let's talk. Okay, the bank reserve are notes and coins in a bank, valued or in a deposit account of the South African Reserve Bank. You still remember we talked about South African Bank. We're actually still gonna talk about South African Reserve Bank, which is SARS. So the liquid assets, this one are treasury bills issued by government to finance currency. They finance currency. So how I actually explain this in my notes, it says like liquid assets, they can be easily created into cash, right? So with no risk of loss, and they have low interest rate. They are issued by government to finance current spending, as a commercial papers. So this one you just have to know they are easy to be created. So they can be created into cash with no risk. See, and of loss, and they have low interest rate because they don't have risk, because low risk of loss. So that's why, yeah. So then when we're talking about the investment security, this one they have like they are riskier than liquid assets, and they have like a high interest rate than liquid assets. But then when you're talking about loans, you have to know that I think I've already explained loans already. Okay, loan is actually like the highest risk of taking. They're actually taking the highest risk, so that's why they provide. It has like the highest interest rate loans. So, for example, like if we're talking about loan, why it has a highest interest rate is that because bank might give you a loan, and some people they won't even pay back, right? So not paying back the loan is actually a very disadvantage thing for banks. It's risky. It might make the bank to collapse. So that's why they actually like tend to lend more people loan, people who want to buy a house, people who want to buy cars, and all these things. So that's why they give like so many people a loan, because even if you don't want to pay, they're still covered, right? But then there is a high interest rate, and loan it is risky. Liquid assets is not risky. It has a small interest rate. Investment is riskier than liquid assets. So those are the different. Then when we're talking about economic benefits provided by the depository in institution. So economic can actually benefit from all of this. How? By creating liquidity. Liquidity is not, remember, liquid assets. Okay. They create liquidity. How? They borrow short and lend long. That's not that. They borrow short and then they lend long, which means that so that the economy can actually benefit if the banks are actually borrowing short, but then borrowing is like when they're taking I guess there are times like when banks are they're actually gonna be struggling, so they have to borrow like from other banks. So they have to borrow short, but they have to lend more. Lending more is actually their way of creating their income. Actually, gonna make them to have more money because of the interest rate. Because the interest rate of people who are lending from the bank, or actually taking loans from the bank, the interest rate is actually high. So that is how they actually create money, and then economic is actually benefiting from that. They pull risk. How do they pull risk? They actually pull risk because they don't want to lend like only one person money. So they provide loan to at least like thousands of people, right? So that even if you default or if you don't want to pay, they're gonna still be covered. So that's how they actually pull risk. And then lower the cost of borrowing. They don't want to lend they don't want to like borrow more from other banks, so they have to make sure that okay, let's not lend a lot of money from other banks, so that because if a bank actually lend a lot of money from other bank, what actually gonna happen is that that bank is actually gonna lose a lot, because that bank that it has borrowed money from, the bank that it actually has borrowed money from is gonna need like a high interest rate from that bank that actually has taken money. So that's a lose. So they have to make sure that they lower the cost of borrowing, and then they lower the cost of monitoring borrowers. So by monitoring borrowers, it's like a lender can encourage good decision that prevent a default. So how depository institutions are regulated? I think I did, that. You just have to know about the effects of regulation, which are you have to improve technology and um, repeat of native building um, to larger. Okay, so failure can be damaging effects on the entire financial system and economy. So depository institutions are required to hold levels of reserve and owners capital that equals to the surplus ratio, and laid down by regulation to minimize risk. to minimize risk. So financial innovation. So in the pursuit financial or innovation sexual talk, you just have to know about the things: economic, environment, technology, and regulation. And then you have to know economic environment is okay, the the economy, technology, and regulation. So you just have to know about those things. They do come to multiple choice, right? So we're talking about money. We're talking about a SARS now, the South African Reserve Bank. What is it? South African Reserve Bank has been created in this kind of year. What it does is that it help to stabilize the money, so that the economy can grow nice and everything. Yeah. So that is what actually this talk is talking about. Wait. Okay. Please, guys, don't sleep. Right? Don't sleep. Wake up. You have a future to work for. You recently have a future to work for. So if you're talking about Reserve Bank, what we're actually talking about with the Reserve Bank is that so Reserve Bank is the central bank of the Republic of South Africa. It was established in 1921 and has been entrusted with a monetary policy. So what is a monetary policy? A monetary policy like it has like two things. It has money and policy. What is policy? Policy is like controlling money. So it's the way money is being controlled. See. Yeah, that's the definition of monetary policy. It's to contain inflation. It may instruct the monetary policy set course. So the government appoint the majority of the members. So there are members that are actually being appointed by the government in the SARS. So we have a governor. We have three deputy governor. We have three deputy governor. We have four other directors and seven directors. So we have directors that are actually appointed by the president too. So the governor is actually appointed by the president. Even the deputy governor, the actual president, appointed by the government. And then we have the three directors who actually the four were actually appointed by the government. And then we have seven directors. The seven directors are the one that actually being appointed by the shareholders. So you have to know that that's a structure of a SARS. So a central the central bank is a bank that regulates nation, depository institution, and control the quantity of money. It controls the quantity of money. That's monetary policy. So the Reserve Bank goals and target. So what is target? Its target, you have to know one of its target is to reduce inflation, right? They do care about inflation, those people. I don't think it is written here, but they do care about inflation. So adjust the quantity of money in circulation. So it has to make sure that the quantity of money is being controlled, like the circulation of money is they adjust the circulation of money in the economy, you see. And then our primary our goal to achieve and maintain price stability, the one that this one is very important. They maintain like the price stability. They have to make sure that the price doesn't go high and then the price doesn't, yeah, to go low. Of course we all want the price to go low, right? But they have to make sure that the price doesn't go high, so they have to control the stability of the price, so that they can save the economy, so that the economy can grow nice. So the Reserve Bank takes responsibility among others. So these two, they are the function of SARS. You have to know them, these two. But most of that is actually asked is the primary goal to achieve and maintain price stability. So these are the responsibilities that are actually being taken by SARS. So they formulate and implement a monetary policy. They issue banknotes and coins, external banknotes and coins. So they issue them, like they give banknotes and coin, and then they do that thing. They give actually the report to the parliament. So they actually like took the banknotes and coins to the parliament, and then they have to read or how the industry show is actually going on, you see. So they supervise the banking sector. The banking sector is also talking about the depository institutions, said they supervise them. So banks, they actually refer to SARS. See. Yeah. They ensure the effective function of payment. If you are not getting paid enough, you can go to SARS and be like, hey, I have this boss who's not paying me enough. So they've actually um influence, they ensure the effective function of our payment system in South Africa. They act as a banker to the government. That's where the government get the money. The government, if the government is, yeah, is having a shortage, the government want to build a bridge, and they don't have enough money, they go to the SARS, they go to the South African Reserve Bank. They act as a lender to the last resort. The last resort, actually talking about bank. If a bank is failing, it goes to South African Reserve Bank, and then they're gonna go there and lend money. But they just don't lend money. They have to make sure that that bank is actually falling, and that thing is gonna affect the economy. If it doesn't have anything to do with the economy, they are not gonna lend you money. So that's SARS. So the structures I've already mentioned. It's not owned by government. You have to know that it's actually owned by shareholders and the accountant to the parliament. So we have, it has like board of 15 members. You still remember one governor. We have three, and we have four, and then is it four or seven? Yeah, I think it's one, three, four, and seven. So that makes up the total of 15 members. So the monetary policy committee, it have so the MPC, which actually I'm talking about, the Monetary Policy Committee. You still remember controlling of money. Committee is like, the committee is a group of people. So it's the main policy making organ making organ of South African Reserve Bank. It is made up of 5 members, including the governor. 5 members we're actually talking about. How many do we have? Yeah. We have the governor, the three deputy governors, and the senior, which is one senior official of the Reserve Bank. So that's the MPC of the Reserve Bank. Um. So the Reserve Bank policy tool. Oh man, this one is very much important, bro. It actually have the policy tool. This thing. It has the policy tool. Always remember that the SARS, they do have to meet for like every 2 months. So this committee people, they meet every 2 months to discuss. They discuss the state of domestic and international economy. They have to meet, and then they have to submit the report to the parliament. That is what they have to do. You have to know about the required reserve status. Oh, we're actually talking about the policy tool. So the policy tool, we have a required reserve ratio, the repo rate, open market operation. Oh man, I was talking about this thing yesterday. The repo rate is the interest rate that they actually provide to the banks. The banks that actually lend money. You see, those are the repo rate. Those are the repo rate. Yo, guys, hey, this thing is too much, man. This thing is too much. I think let me just finish this thing up, right? Yeah, I think this is the only part. Then we are done. This is the only part. Then we are done. So you have to know about the open market operation. The open market operation actually talk about the SARS and the bank, like the gain and the loss. Now, if a SARS buys security to the bank is gonna gain money, but it's gonna lose security. If the bank buys security to the SARS is gonna lose security, but it's gonna gain money, and then bank is gonna gain security, but then it's gonna it's gonna lose money. Minus and plus, minus and plus. So this what actually this table is actually talking about. Security is being added if the Reserve Bank buy security from the net bank. So here security is being added to the Reserve Bank, but then it's gonna be subtracted from the net bank, right? So but then the reserve is gonna gain the money. It's gonna gain 100 rand, but then that one is gonna lose 100 rand because it used that 100 rand to buy. That's actually what it's talking about. How money is being created, a very nice topic, but then we're gonna talk about how money is being created when we come back. Um, okay, so thank you very much for watching. I hope you learned something. Just know, or we talked about money. What is money? Money is a means of payment. We talk about the three functions of money. You have to know that is very much important. We talked about money in South Africa, talked about this currency, we talk about the deposit, we talk about the measurements of money, which is M1, M2, and M3. We actually talked about debit card, which are not money. We talked about credit card, which are not money, and then we talked about check check that are being returned by individuals. They are also not money. We talked about the industrial institution, where we have which the in the depository institution is the institution that actually take deposit from individuals and firm. See, they take this thing from individuals and firm, and what see. We have three types of institution: a commercial, a mutual, a post, and land. I did explain them. They are very important. What else? The provision and procedure on what depository institution do. You have to know about the four assets, the types of assets. I still remember them: the bank reserve, the liquid assets, the investment security, and loans. You have to know how actually economic benefit from depository institution. You have to know about how the financial innovation. You have to know about the SARS, right? So we did actually three things here. You have to know about the SARS. What is a SARS? What is its function, and then what is its responsibility? You have to know the structure of the reserve bank, how many people it has. See those things. The monetary bank. Then you have to know this policy tool, which are three: the required reserve ratio, which it does have a formula. It's depository, what I forgot. And then we have the reported risk, the interest rate that is actually being made to the bank that actually lending the money from SARS. So they've it can go like to 2.5% or 5%. Then you actually have to know also again about the open market operation, which is the selling and buying, forex, selling and buying, selling security, but then they're gonna also buy security, which it has the gains and the losses. And then we're gonna talk about how bank they actually create money to the next lecture. Thank you so much for watching, guys. I really appreciate it. I guess we're still gonna catch each other tomorrow. I actually recorded this thing very late today because yeah, I